Hello, everyone. Welcome to the weekly roundup. Today we will cover monetary policy, inflation, and market sentiments. Hello, Ben.
Hi, Eva.
Good to be back.
Yes, couple of weeks. I missed you.
Yeah, you've been riding solo.
Yeah, exactly.
Well, lots to cover today. Let's see how fast we could be. We're starting with monetary policy. The hawks are circling, and the market seems to be quietly pricing in the possibility of a hike. What are we expecting from the Feds, and how should investors think about the impact of higher rates?
Yeah. So I think it's a great place to start. And yeah, I feel like obviously the headlines are the part I think that's more scaring the market into the direction of the decision as opposed to listening to what the central banks are saying. But yeah, so the market is starting to price in rate hikes in Canada for sure. And in the US, there's still a possibility of a cut. I think there's a higher possibility than being priced in, but let's just start and stay with Canada first. So our current update, at least from our economics team, would have been this week, talking about what they think will happen. And right now, still sitting with Q1 of next year, a 25 basis point increase. And if we look at inflation data in Canada, it came in at 3.2% annualized anyways, which is a little bit higher and highest level in, multiple years and months. But yeah, I guess the fear around inflation is, are we going to have COVID inflation and we get up to 10, 12, 15%? I'd say that's pretty near impossible. But of course, anything can happen. So on Canada's perspective, yes, the market's pricing in hikes. I'm not sure. We still got quite a few quarters to cover before we get to that.
Yeah.
But that's why you've seen yields start to move up.
Okay.
And Pelez has said that oh, sorry, Pelez. That was our old central banker. But the Bank of Canada says that effectively that they're going to review it one day at a time, kind of thing. So we'll see. And if we look at Warsh down in the US, then he has always been vocal about cutting rates, and so I would be surprised if we don't see a rate cut in the US, but your point is right. The market is not pricing that in right now. And so that would be a surprise to the market and probably be a positive for bond prices and a positive for stock prices. And so those would be the things that I'd be certainly watching closely on that side of things.
Okay.
Yeah.
So I read something interesting today that even the opening of the strait is not gonna help the inflation situation and where the economy is now.
Mm.
What are your thoughts on the real impacts of geopolitics and, even if everything dies down, are
Mm.
we able to, get through it and get back to where we were?
I don't think anything ever gets back to where it was,
Mm,
unfortunately. So I think that's right. I think that there's probably that risk to continuing higher prices. And so if you look at what Iran is requesting and or potentially getting is increased fees on pass through the strait. So that's a definite loss to the world and a risk to higher prices. So I think it's something to be cautious of and conscious of, but the global economy is still pointing towards somewhat of a one handle on GDP growth this year. And so if you look at global GDP, something around 1.6% expected this year. If the economy continues to slow, that's pretty close to getting closer and closer to zero. So I would say that the answer is yes, there's some risk to it, but if people stop shipping, stop buying, the consumer continues to be under pressure, that's the flip side of it. And technology is inherently deflationary. I know nobody wants to talk about that, but as technology speeds up, that's going to cause further move towards deflation as opposed to inflation.
okay. So on the equity side, and my last question, tech has been doing much of the heavy lifting.
Hmm.
But now that we're starting to see some names are pulling back, is just a breather, or is the market telling us to look for leadership somewhere else?
So it's a good question. I mean, AI and the big leaders, Microsoft, Amazon, course, Micron in the memory space. Like these things have gone up crazy. We saw the SpaceX IPO, and so we've had lots of, I'd say, big names coming under pressure. To your point, and
Yeah.
so one of the things that I like to look at, and we like to look at, is just really the breadth of the market, and it's actually been expanding. So as the market's potentially been treading water here the last little while, there's been underlying stocks that are starting to pick up that were undervalued. You get small cap value is the best performing, we'll say, asset class in the US so far this year. And so you've seen some of these undervalued names starting to pick up, and the market's been treading water. So, I mean, I think it's an interesting thing that I'm spending some time thinking about is could we see the S&P close roughly where it is right now, the end of this year, but still see some stocks go up 20, 30, 40% that have been undervalued the last few years. And so I think that's how I'd be thinking about it. And so as we've had this kind of move on really this cap weighted market has been going up, up and up. There's been a lot of stocks that have been left in the dust that have not moved in 2 years. So, my thinking today would be around markets probably tread water for a bit, but there's still opportunities to make money in individual stocks and stock picking. And so that's where we'd be looking to add value in the best way we can.
Let's see the charts.
Okay. So we're recording this on Wednesday, June 24th, around 1 p.m. So anything that happens between now and next week, we'll comment on next week. Let's just start off with this. There we go. So I guess I did have that number right. 2026. So this is the World Economic Outlook. So this came from our most recent report, which came out yesterday, just to give an update on forecasts. And I think, again, it's important to look at these numbers. So advanced economy, we'll say GDP 1.6, and then world 2.9. And so I'd say on the advanced economy, so the US 2.1 to 2.3 to 2.1 is the expected forecast. Eurozone, I think, is an interesting call out that I'll comment on in a minute. Canada 1.9 to zero point 0.7, and then a jump from there. And so I would say Canada, this is obviously very important to us, but with a zero in front of the expected growth, we need to be pretty serious about what we do here. And so I'd say fiscal and monetary policy will be important to watch. If that number ticks down a bit, then you probably see more talk of stimulus as opposed to tightening. And the Eurozone, they actually raised interest rates in Europe a week and a half ago. And so that's a little surprising to me as their economy is stalling and slowing, that they're raising rates. So they're quite fearful of inflation. And so that'll be something I think important to watch. But just from a market perspective, I think I'd be looking at where these countries expect to grow down in the bottom of this, which is in the emerging countries. We look at China probably sideways, India probably sideways as well. But then you have Mexico that looks like it could pick up. So maybe there's an opportunity there because some of the stocks in the market in Mexico have come under pressure. So this could be an opportunity to look at what's next for an investment picture. This hits a little bit with my talk about the consumer. And so this one is the US, the savings rate has sunk to a post-pandemic low. And so this just gives you a sense of the pressure that the US consumer is facing today. And so you have higher rates, not only on the long end, which is their mortgage rates, but definitely on the short end as well. And so the savings rate shrinking typically means the consumer's under pressure. The consumer is such a major part of the US economy that you don't want the US consumer under pressure if you want an expanding economy. And so this will be an important chart to watch. But if you look at previous bottoms here, these numbers were times where the US government started to get concerned as savings was going down, which means people were spending more and more money to live on a daily basis. And just two more quick ones. So this is the US, and this is our discussion for rates. And so on the first one here, this is Fed funds. So they would be forecasting the current view is Fed funds is flat. And so if we look at into the future, though, they do expect 50 basis points next year. So this is 375 to 3.25. The current market is at these levels. So if you look at the 3-month Treasury bill, this is more of a view of what the market is pricing in. So the market's actually started to price in potentially some cuts. And so if we look here where we are today, the market's starting to say maybe we do see rates come down. What I think is interesting when I look at this across this 30-year number, I think is very key because the 30 years it controls the mortgage market in the US. And so interestingly enough, it shows that this starts to creep up. And this falls a bit in line with Warsh's theory where you can shrink or lower the front end and let the market control the longer end. So I think as a result of that, the market's starting to price like some expectation that he's not afraid to let the long end of the market creep up. Again, this surprises me a bit because the US consumer cannot really handle higher rates at this point. So these numbers will be important to watch as we progress from here. So your question about Canada. So this is where we are today. So this is Canada's numbers. So currently overnight 225, expecting Q1 of next year, as I mentioned, 25 basis points higher, and by Q2, 50 basis points. And so this would be again contingent on what happens to our economy from here. If we look at the prime rates, this is what the banks lend at, and so that you see that creeping up. And then if we look down in the bond market, Canadian bonds have been in much more demand. And so we're almost a full 100 basis points, well, more than that, 100 basis points more than Canada versus the US. And so there's been a lot of money that has moved to the Canadian market. Um, and we've seen the most amount of foreign investment that we've seen in a long time in Canada. Some of that in Canadian dollars, some of that in US dollars. So there's institutions around the world that want to own US dollars but don't want to own US treasuries. So they've been buying what's called the Yankees, which are Canadian government denominated US dollar bonds. And so there's been a lot of demand. So this is a risk and opportunity, but this is why rates are significantly lower than where they are in the US at this time. I think it'll be important numbers to watch from here. As always, the opinions expressed do not necessarily reflect those in National Bank Financial. I prepared this report with the best of my abilities. Should you have any questions about any of these things, please reach out to Eva or I, and we're happy to discuss and see if anything is appropriate for you in your investment portfolio.
Thank you, Ben.
Welcome.
What's on the agenda for next week aside Canada Day?
Yeah, so next week, historically at least, has been the quietest trading days and week of the year. So we got Canada Day on what day is that?
Wednesday?
Wednesday, yeah. So Canadian markets closed, and then on what the Monday, I guess, is the
Yeah,
4th of July
4th.
holiday
Yeah.
in the US. So I'd say the next 5, 6 trading sessions are going to be a little bit lighter. Good time to just think and reflect about what's going on. Maybe there's some settlement of some sort in the Middle East that can be looked at as a positive, but I'd be looking at that. We've come kind of to the end of reporting. We had Micron report today with their financials. That's the big memory AI play, and they were decent. That stock's been extremely volatile, so I'd still be looking at those numbers. Yeah, I think that there's a lot to pay attention to still. The movement in oil and gas as well. We saw oil touch $76 a barrel this morning, which is a new short-term low. And so we'd see the market starting to say, okay, maybe we get returned to normal a bit. And that would be a big signal to that inflation risk that everyone's talking about. So I'd be watching that right now. And as usual, we make some adjustments in portfolios. We made a small change there yesterday, trimmed some Intel and added Netflix for the first time ever. So we'd be watching to see how the market's reacting to those adjustments we're making.
Okay, perfect. Thank you, Ben. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video and in your email box if you're subscribed. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you once again for listening and enjoy the rest of your week.
Thanks,
Bye.
everybody. Take care. Bye.